Hi, and welcome to the latest episode of the Motley Fool's Bottom Line series. In this video, we're going to take a look at 3 reasons why most professional investors can't beat the market. While some investors feel perfectly comfortable being the purveyors of their own financial destiny, many turn to professional money managers to grow their wealth over time. The assumption is that money managers know the ins and outs of how to make their clients rich over time, but the data tells a different story. Since 2001, the S&P Dow Jones Indices has released its annual SPIVA US Scorecard Report, which examines the performance of fund managers relative to their most closely linked benchmark index. So how does Wall Street stack up? Well, let's just say a blind coin flip might give you a statistically better chance of beating benchmark indexes. Over a 1-year clip, 68.8% of all domestic funds underperform their respective benchmark index. And things look really bad when the performance of fund managers is examined over the long term. Over the past 15 years, a whopping 88.9% of domestic funds have underperformed their respective benchmarks. So why are fund managers so bad at their job? There are likely 3 reasons. The first reason is that many fund managers are too focused on the short term. Research shows that an average of 5 out of every 8 stocks in a domestic fund are being changed out every year. That suggests some very short-term and emotionally oriented thinking on the part of money managers. The problem is that it's impossible to predict with any long-term consistency what's going to influence the stock market in the short term. According to annually released research from JP Morgan Asset Management, a majority of the S&P 500's best trading days often occur within 2 weeks of its worst trading days over a trailing 20-year period. Timing those days is an impossible task. Yet based on the 63% average domestic fund turnover rate, that's exactly what money managers are trying to do. Secondly, many professional money managers fail to recognize a bad investment. Back in December 2016, The Economist examined all equity ratings for companies in the S&P 500 and found that 49% of all stock ratings were the equivalent of a buy or outperform, with another 45% being some equivalent of hold or neutral. This means that a mere 6% of all S&P 500 stock ratings were a sell or underperform in 2016. Meanwhile, about half of all S&P 500 stocks underperformed the index that year. Some money managers may be wary of giving stocks a sell rating so that they aren't labeled by their peers as a fearmonger and so that they don't burn bridges with the companies that they cover. But as the data shows, fund managers aren't doing any favors by allowing their bias towards buy ratings to influence their investing decisions. And finally, the third reason why most fund managers fail to beat the market is because there's no true accountability. Since fund managers generate their own income from upfront fees, the performance of their portfolio often has little long-term impact on their wallets. The bottom line is that if a fund manager underperforms the market, the only one who walks away a loser tends to be the investor who put the money into the fund. Thanks for watching this video. Do you think fund managers can help investors beat the market? Let us know what you think in the comments below. And if you like this video, give it a thumbs up and click the subscribe button. It helps us reach more people, which allows us to make more awesome content.